Welcome everyone to the Kendall Report. Sorry about the dual music. I was playing with some settings earlier and obviously had two different things going on at the same time. Sorry about that. Anyway, welcome to the Kendall Report. It's Sunday night. We have a lot to talk about, as it turns out. It's the world's just getting crazier by the moment, and I titled this that the Dow basically is destroying the planet. There's a shortage of dollars. The Fed policy versus everybody else is just way more hawkish. And we're just seeing a continuation of just a massive sell-off, especially in the currency. Just a quick comment about an hour ago or so, POC came in and intervened in the yuan. It's printing 714 right now. That's a very big number. And they put out some emergency reserve requirements. I didn't get to read up on exactly what they did, but even the Chinese are panicking. In North Korea, they're shooting missiles up because they can, and there's just it just gets crazier. I think by the moment, from the standpoint of all of the dynamics that are around the markets. So where to start this week? I'm going to go into some longer term things that I'll set this up in a few minutes when we get into the indexes. But I'll go through some of the quarterly charts. We're coming into the final full week of September, and it's been a pretty rotten month. And I know I've been criticized for saying I didn't think it was going to be that bad of a month. But we're now all of a sudden trying to print all the way to the lows of the previous quarter. And the big number and the low was 36.36. And we certainly could challenge that over the next several days. So it's going to get interesting. And I'll talk about the implications of some of these numbers here in just a few minutes. But I think that the Chinese even starting to panic is getting very interesting. And I think I'm going to go through the dollars. So I'll bring up the yen. I saw something really interesting happen in the yen last Thursday, and they were intervening. So everybody, meaning all of the central banks and governments and everybody, is trying to head off this situation with the dollar, and maybe they'll be successful. I've seen this kind of stuff before, but it wasn't until I would say it was around in the really early 1980s when things were pretty crazy, but it was crazy in a different way where the dollar was getting hammered. So we're in a much different situation. We got massive debt. We're starting to see cracks in the auctions on the treasuries. Everything's going on. I can't tell you, I bet I ran across, just not even looking, I ran across maybe 10 stories of people saying that the bonds are, their value in the bonds, and don't see it at all. I don't see yields stopping here. They may stall for a while, but I'm not sure there's some kind of magical low at this time. We've got a fair amount of stuff that's coming out. You know, we're going to get PCE this week. I'll go through all the economic releases here in just a minute. But just I guess we're coming into a big week because we're going to most likely get some rebalancing, quarterly rebalancing, a lot of things as we get toward the end of the week. So we'll just see how it sets up, go through the week like we always do, step by step. So looking back on last week, before I go into looking forward, last week S&P down 4.6, down 22.5 on the year, NASDAQ down 5.1, down 30.5 on the year, and the Russell minus 6.8%. And I just thought of something. I want to make sure that I put this out there. Hopefully nothing happens. I've been having issues with TradeStation getting an error. And if I accidentally close this box, I'm going to have to reboot my computer to get up. So I'm going to be very cautious if that happens. And all of a sudden, I will have the option, I believe, if that happens, to tell you I'm going to do it. So hopefully we don't end up with 2 live streams tonight. I'm going to be very, very careful with that. Just want to put that out there. So if something happens, I'll let you know, but be aware that there is a potential risk here as we look at things. But, you know, all the sectors so far have been negative. So September, I know everybody talks about how September is the worst month, and it is overall the worst month, but there's been years where it hasn't been. But it has definitely been pretty bad here. And my original analysis, if we go back to as we're coming into the end of June and we're coming into this quarter, my thoughts were that we would get a rally into the quarter. We did. We got up to 43.27. That actually was one of the targets. And then, of course, you know the rest. Since then, everything has been derailed and markets have been under massive pressure, and there's just no buyers to be found. You'll see in the database, I believe Friday's video was named full liquidation mode, and that's exactly where we are. I'm going to show you a couple other things that I think are going to tie everything together also when I go through the database. So, like I said, a lot to cover. Let's go ahead and let's talk about looking forward here. On Tuesday, there's absolutely zero news coming out on Monday. And Tuesday, we get durable goods, expected up 0.2, FHA housing prices minus 0.1. I think it's going to be worse than that. I think prices are starting to come in pretty good on the real estate. Consumer confidence, 104.7. Numbers are expected to stay up. I'm not sure what's going on. And I've talked about this in the past, where we keep getting these labor numbers and, you know, just continuing to be very robust while everything else seems to be crumbling, and it feels like the end of the world, but the labor market's still going. So this is the big, I guess, conundrum that everybody is fighting with right now. Labor markets are good, but everything else looks bad. So maybe I think ultimately labor markets will start to roll over, and I don't think there's a lot of reality in all these open jobs that they keep claiming that there's, 11, when you get the JOLTS report and there's 11.5 or whatever number of open jobs. I don't know that that's very accurate. I think it's a sketchy metric to be basing things on. But as also we get new home sales on Tuesday, expected to be 510,000. What you're seeing, if you go in, it's kind of interesting. Go to some of the national home builders and go to their website and see what neighborhoods they have that are for sale, and you'll see price reductions across the board, anywhere from 10 to 20. I've seen some at 25%. If you go and look at that, so that probably if you're looking to buy a house, a new home's probably going to be the best. The problem is you're probably going to end up with a 7% mortgage. So whatever monies you save on the prices aren't probably going to work out very good. So we come into Wednesday, we have pending home sales, which is 1.7, supposed to be down. We also get another revision. GDPs comes out on Wednesday, expected to be minus 0.6. Deflator 8.9, and then we're looking at those numbers. I think are likely to be as expected. I don't expect any surprises there, but we're not going to see any dissipation or any downsizing of the inflation numbers that are coming out this week. We're also getting PC. Well, before I jump forward, claims come out, and the claims have been coming in just a little bit. I thought they would increase. They haven't. 222,000 expected for this week, and continuing claims did not. All of a sudden, they're at 3.379. So they've actually been dropping. And so this is what I was just talking about. The employment numbers continue to be much better than anyone would expect they would be. And you just wonder if the books aren't being cooked sometimes. Although, I'm sure maybe you folks can comment in down below here, but what I'm seeing around is no one seems to be worried about their jobs right now, which is interesting and good at the same time, right? So we'll see how this all plays out in the end. So we get into Friday, we got PCE coming out, expected to be up 0.2. The year-over-year numbers, 6.3%. That's the number that the Fed's hanging their hat on. There's also, I believe it's a core number within there that's around 4.3. So they're going to find the lowest possible metric they can, and that's what they're going to point to, and that's going to be their target, even though maybe CPI and PPI are going to be much hotter than that. They're going to find a way to get their dialogue to where they want it to get to. I'm not sure who came up with the magical 2% inflation rate, but it's been around for a long time. They've been talking about it for as long as I can remember. All right, so let me just look at my notes, make sure I've covered everything. Yeah, so all sectors were negative so far for the month. I don't see that turning around. And the other thing, we got the Fed to come out last week with a 0.7 increase, and they're advertising right now November is going to be a half a point, and then December a quarter point. That'll put us at 3.75 to 4. Right now we're at 3 to 3.25, so that'll move us up to 4%. I'll talk a little bit more about this when we go through the 10-year and expectations as we look at what's going on here with the interest rates. So let's go ahead and dig into the database. Got a couple of things I want to show you there. So here's the numbers. I'll tell you the daily or the short-term database now is 9.75% bullish. That's about, it'll get down into the 6% level. When I talked about this going back probably 2 weeks ago when we came off the 55%, it just started getting liquidation. Everything was rolling over. We now have 0 sectors on a daily long. Everything has been liquidated. In fact, the final sector was energy. It got blown out for tomorrow's opening. So there's literally no safe places to hide anywhere. So we're looking at this 9.75. I'm going to bring this up and go to the weekly. And the weekly right now is 27.83. Give you the numbers and what we got. We had 1,813 sell signals, only 104 buy signals on a weekly. And on the daily, we got 1,514 sell signals versus 46 buys. So just everything liquidating. There's nothing there to buy. I've been talking about this for a while. I'm going to show you something here I think that hopefully you'll find interesting, just to bring in some perspective, because there seems to be a lot of folks that, when I talk about the database, misconstrue what's going on. So I don't have it loaded up. So I'll just show you this graphic I put together. And let me go full screen so you can see it. So we run something called the PPG 500, which what we do is we take all 500 stocks, put it into our PortfolioXpert platform, and we trade every symbol in the S&P 500. We've been doing this forever and ever. This is the track record on this strategy going back to January of 2000. And so the result is the green fluorescent line is the S&P index. The Wavetech PPG 500 is the blue line, and it's up, you can see here, it's up 288% during that time, while the S&P is up 151, and the CAGR is 14.58 versus 7.66. It's 1.9 bigger than that. And you can see the slopes are going to be similar during the selling, but when the markets are declining, but they're going to be muted. In fact, some of the stats here, right now, this strategy as of 9/26 has 115 symbols long. It's got 29.35% invested, 70% in cash. And like I said, I don't have this up. I bring up the current net is approximately 12.5% negative on the year, versus the index being down 22. It's about 10% better. Most of the drawdowns are about 20% better on average of all the drawdowns on across the board. Some of the bigger ones it's more substantial, but it averages out that it's pretty substantial. So it's interesting, I guess, from my viewpoint. This gives you an example of if you apply a strategic and a quantitative process to the index, this will happen to return. So just about a double, 1.9%. And the reason why I show you this is that a lot of folks they like to criticize the database and the numbers and it's lagging and all that stuff. You know, if those of you that are my institutional clients already know these stats. And this is what we've been about for 2 decades. I started this portfolio management company in 1998. So we've been doing this for decades. And this is kind of the result. I was thinking tonight, I thought, I'm always getting these comments that I'm not sure people have a good context. And by the way, this isn't our good portfolio. This is just an index. We have stuff that is 5 times better than this in returns, because if you do a selective process with fundamentals and other things, other selective measures that you can take and metrics that you can use to build portfolios, you can do a lot better. This is just something that we didn't pick. So you can't say we cooked the books. This is just an index. We take all 500 stocks. We trade every stock. We have trade logs. We've actually been audited on this portfolio multiple times over the years by brokerage firms and people that have used our software. So anyway, I just thought you would like that perspective from what's going on. So right now, as I've been telling you, we're 70% in cash on the S&P. So there's still things in there. If I were to bring up this portfolio and show you, there's still things in there that have profitable trades and those type of things from the return standpoint. But there's not. There's, like I said, there's 70% of these stocks are in cash. All right, so next what we'll do is we'll go through the S&P 500. And the S&P 500 is, it's actually coming back pretty good. We were down to 36.79, so we've rallied 20 handles so far. All the PPMs, everything are very negative. We're just trading in this downtrend right now. And we're starting to set up a little bit of what I talk about if you've been in the live room and into a box formation. So there's still a chance that we just consolidate and trade within the ranges. So if you look at the volatility has expanded substantially over the last several days. And that number right now is R2 for today is 37.63, R1 34. We've traded up to 14. There was a little spike off of the reopen tonight, and the low 683, the low's been 679. So basically we've printed S1. Maybe we're heading for an R1. The possibility is to trade within this range. We could trade as high very easily as R2 in here. And I suspect if we stabilize for the next couple of days that we will get some of this volatility to contract just a little bit from that standpoint. The VIX is still under 30. And so it's getting there, but I would just watch very closely. Around 31 has actually the scenario has been to buy the S&P like a 31 VIX and sell the 20. Those basic numbers have worked out pretty good. So we're not quite to 31, but the PPMs are big time in downtrend, 1.11. They turned back on 920 is when they went negative. And I've shown you the trade before on 823 was our last long trade where we exited our last long trade. So we've been out of this position, no long positions in the indices for a little while on a short-term basis. But the pattern that we're seeing here is potentially getting to an extreme. If we look at it's interesting that S3 today is 36.26. I'm going to talk to you about the lows that we made was 36.36, and that's going to be a really key number. I'll talk to you about that in just a second here. But what I'll do is I'm going to go through the daily. We'll set up the weekly as we come into the final week of this quarter and final week of the month. So let's go ahead and take a look here. Actually, I want to back up just for a second. There's 3 Fibonacci targets, 37, 31, which I talked about last week. We went through that. The next level is 35.61 to watch for, and that certainly would not be hard to hit if we get any kind of crazy numbers coming out or anything this week. There's certainly a lot more sellers yet, it appears, than the buyers out there. Just want to make one more comment. There's been a big talk of all these puts being bought, these monster amount of puts, and that makes me, I wouldn't say bullish, but it does make me think that we could have a bit of a bounce. When I see that many folks leaning that way, it always makes you nervous. But the point is that we are getting a box, what I call a box formation on the daily. That really just sets up a sideways trading range. And right now, the PPM, the top end of the resistance right now is around 38.20, 37.80 to 38.20. You can see right here on the it's within the scale of the possibilities for today. Just looking at market grid, R3 is 37.92 and RXT is 38.17. So we've got some really big volatility potential here, and this market just continues to set this up. Let's go ahead and spin over here to the weekly. Weekly has Fibonacci. There's a couple numbers actually I want to mention. Is the Fibonacci projections for on the downside here. There's 3 of them, but the main one is 3350. I just talked about on the daily at 3550. So that would be your first intermediate target. And the only thing that has a chance of saving this market right now is the weekly 200-week moving average. Right now is 35.58, but that would hit that target to get down there, and that would suggest that we would potentially get a bounce off there. There is an upward slope in that 200-week moving average, which typically will set up some support. And in the past, we've seen major support there. Back in 2018, it was the exact low of the move down. We have a much different scenario here, though, at the moment, as far as the slope and the magnitude of the PPMs. Right now, PPM 1 minus 0.70, 0.52, minus 0.61. So all of the intermediate trend is down, and there's a lot of overhead pressure here. That doesn't mean we can't bounce, we can't trade in a wider range. I want you to look at the volatility that's being posted here for the weekly. Last week, if you noticed, by the way, the STX number 3661 on the STX, the low was 3660.25. It was literally within pennies of being exactly on the extreme. And you'll notice also that 3944 was R1. We came just shy of the R1 STX. So this week, if we look at those similar numbers here, 3643 is S1, S2 3576, and that would put us toward these Fibonacci targets as well as the 200-week moving average. So there's a lot of clustered numbers that are suggesting the potential for 3550. But we're going to have to get through that 3636 number. I'm going to show you even more importance of that number here in just a minute. So an interesting number where we're trading right now, the 40-month moving average, the PPM is up at a 0.68, so it's got a pretty decent slope to it, which suggests there's support at 3683. So we've spiked just below that at 3660. So it's interesting that we've gotten right to that moving average, and you have an upward slope on the 40 period moving average. I just mentioned the 200 week that is just below that, but they both have upward slopes, which tells you that there should be some support right where we're trading right now. And I'm going to tie together this 3663, the low that we had in June. I'll tie that together with everything here in just a minute. But the PPMs are big time acceleration on ppm1 minus 0.23, and ppm2 is turning down. It's flat right now, and ppm3 is positive. So what could happen here is that we start to get sandwiched a little bit. This is the final week of this month, so we'll have some new numbers to look at as we come into next week. Actually, on next Sunday night, I'll have some new numbers for you to consider. All right, so now we're going to the next level here, and I want to bring up the quarterly chart for the S&P. And I'm going to try to set this up as fast as I can. What I want everybody to understand is if we go back to January, you can go back and watch some of those videos, we get an outside reversal on a monthly basis. And if you walk, I told you if we get a lower close, make a lower low and get a lower close in February, we'd get at least 2 to 3 more months down, which we did. And then I come to this chart. In the first quarter, we had an outside reversal on a quarterly basis. I can tell you, I don't know that I can find another one of these. So it was very significant. And I was talking to somebody the other day, and I was looking at some reports. I used to do these annual written reports every year, and I was looking at that, one of them, and it was 2017, and the title was Deglobalization, and I could almost erase all the numbers and change the date, change it to 2022 and be right, and it would be very relevant today. It was, at that time, there was a lot of things that looked like they were about to roll over. And of course, we had that terrible fourth quarter in 2018. Looked like everything was there. One of the things, I won't go through a lot of detail tonight, but what I've been talking about since around 2016, 2017 is what I've been talking about is that this is the chart. Well, the reason why I bring this up, and I'll go full screen here in a minute. But the reason why I bring this up is that I believe there's a potential that this is a generational high. So this is a high that we've seen in January of this year that will be a high for a very, very long time, that we won't see another ATH all-time new high for a while, maybe decades. And you go back to, it took from basically from 2000 during the dot-com situation, it took us all the way to break even, really, for a lot of strategies. They didn't break even to 2013. They talked about the lost decade. And in the secondary top in 2009, we actually made a new high by just a few pennies. And then the market reversed and dropped another almost 50% from there in the GFC, the great financial crisis. So what we're seeing from the standpoint of what's going on right now, this is more analogous to maybe 1976. For sure, in the middle of the screen, let me go full screen, is right in the middle where my cursor is here. This would be very similar to the dot-com, where we had a 2-year crisis and we just continue to go down. We did not have an outside reversal bar, but we have one now. And I'm just going to tell you that it's not super important, but it would, absolute confirmation would be if we take out 36.36 in the next 5 trading days before the end of this month, we just have to print 36.35.50 by a penny. I don't care, just to take it out. It's not really necessary, but you can see that we've got 3 bars down, and the outside reversal bar, those of you who've heard me talk about this 3-bar, it's a 3/5 bar trade. This is exactly it. We fulfilled it on a monthly. We're now we got a confirmation in the first quarter lower close. We're now getting another lower close. And what that suggests, there could be 2 more lower closes that would suggest that we would decline into first quarter of next year. That would put Q4 and Q1 of 23 in the crosshairs from that standpoint. The minimum target here is, and all these numbers are starting to line up. So the 10-quarter moving average, I'll just give you the numbers. I know they're probably smaller on the screen you're on. 39.57. So we're going to close under that. There's no doubt about that. And the 21 right now is 33.38. So all those Fibonacci numbers I was just talking about, 35, 33 handle, that would be a move down to the 21-quarter moving average. And I didn't put any of the PPMs up here or anything for this discussion because I really just want to look at price. So very easily we could go down to that level. And going back full screen here is you can see back in 2000, that was the fourth quarter. There was 4 quarters down, and that quarter actually bottomed right at the 21 period moving average. Got a little bit of a bounce, and then it continued down. There was only 2 quarters higher, and this goes back to the .com scenario, all the way down into the lows of October and in the fourth quarter of 2002. So I just want to continue this conversation just for a little bit more, because this is a very big event. I talked about it in January. I thought we would get a rally back, which we did get a rally. Right now we have an inside bar working on the quarter. Like I said, it won't take much. I mean, we were within 30, 35 points of printing this low. And like I said, it doesn't have to occur. It would be more of a confirmation and I guess raise the probabilities. But right now, it looks to me that we'll stay under the 10-quarter moving average. That's right now, let me just give you that number again, 39.57. We'd be lucky to rally back there, but we should stay around there. I've talked about a 40-20 number is a possibility within that square kind of pattern that I talk about on the market grid. So there's a lot of things that could happen. We could, as we come into this next final quarter, we could see definitely some just sideways and maybe continue to move lower. My expectation is we're going to close very weak. I'd be shocked if we got some material rally from in these current conditions. Certainly anything's possible because we're going to have quarter end refunding. There's going to be a lot of things going on. So as always, I just want to go through, I told you I would go through a longer view perspective of what's going on with the markets from that standpoint. There's so much. I think we could spend about 4 hours if we were to go through and just go through a whole array of different things. And I'm trying to figure out how to maybe focus on different elements on different nights and do what I'm doing right now for the S&P, maybe looking at some other metrics. And because I think, I'm not totally into the camp, but I'm getting closer to falling into the camp that we could enter into a pretty massive deflation if the system gets broken. And I am going to cover the dollar tonight, so it's probably going to be a long video just for the record. And I'm just going to keep going on all this stuff, and you can watch it on replay if you're just seeing this right now. You'll be able to spin forward. We'll get the timeline all marked up, so it'll be fairly easy to find. So let's go ahead and move on to the NASDAQ. But I think I wanted to spend the time with you folks to set up this scenario and what's going on a larger scale. And this is the same setup that been talking about all year. And I showed you the S&P strategy. I could show you a lot of stuff. We've been in heavy cash all year, and it just amazing that that there hasn't been any material bounces to get our intermediate models in. We've seen the short-term models ebb in and out a couple times. Now, like I said, we're in full liquidation. We're completely out of just about everything now. So let's go ahead and get into the NASDAQ. So I'll just leave the monthly up. So we'll keep a little bit of a longer term perspective tonight. And you can see we've taken out that 40-month moving average. I've talked about this before, but the NASDAQ is leading the way on all of this. And we've got massive downtrend numbers, minus 3.52, 0.55, and the PPM 3 is positive, 0.87, and that is at 11,900. So we'd have to rally 600 points between now and the end of the month to have any luck at maintaining that support level. I don't see that happening, but that is going to be your major resistance, and that's a pretty far-fetched idea, I guess, talking about a 600-point rally. I'm not saying we're going to get that, but that's what it would need to get there. So let's spin over to the daily, get into the short-term analysis. All of the basic concepts and everything I was talking about on the S&P will be the same as we look at NASDAQ and the Russell. So as we go here, S1 11,286, the low 11,284. So we hit spot on the S1. R1 11,467. We're a little shy of that high of 11,397. So we're looking at just short of doing S1, R1. For whatever reason, look at the PPM 2 is turning up. And it looks like to me they're going to try to press an R2, maybe get a recovery. We'll have to see as we get some of these metrics, especially as we come into the week. And going back and we've got Wednesday GDP and then Friday's the PCE. So we've got a couple metrics that could have material effects from the standpoint of what market reactions might occur just on that type of news. But it's interesting that we're seeing the PPM2 not only turn up, but it's taken out its first derivative. And typically that will suggest that we're going to rally back into resistance. Don't really see it, but it is, there is going to be a lot of overhead resistance right at R1 for sure, that's 467. R2 is 11,568. Just a ton of resistance up there. And all of these trends, as I showed you on the weeklies on the S&P, are all negative. So I'll just bring this weekly up as same scenario here. We're in trend mode across the board. All three PPMs are in negative 0.91, minus 0.56, and minus 0.94. So weekly trends are big time. Even if they bounce, it's not. You might be able to play the dip, but it's really more sell the rip on these rallies if you get into some material resistance from that standpoint. Next is the weekly Russell. Let me go to RTY instead of the cash. RTY, really just flat. Everything's very negative. Minus 7.72, minus 0.43, and 7.3. Anything under 0.25 is trend down. And just overhead resistance, 1858, which is so out of bounds, it is not even worth talking about. All we can really do is look at the market grid. And right now we're printing 1678, R1, 1719, S1, 1652. So we've not quite printed. We're trading in between S1, R1, but same kind of standards that I just talked about on the S&P and the NASDAQ. All right, now the fun stuff, the yields. I thought it was very interesting. We'll bring it up in a minute that we did see a pretty decent reaction off. We printed up to 3.83% the other day, and this is the weekly, and the weekly extreme RXT was 3.64. We closed at 3.69, so we actually got an RTX sell signal. My expectation is that we will go sideways in here. I've been talking about these Fibonacci targets. Let me bring them up so you can see them on the screen here. The Fib targets were two that I've been talking about, 3.60 and 3.78. So we printed up to, we got a high there at 3.773. That's what this chart's showing here. I thought we had printed up to 3.882, but showing 3.8, right, basically right on the Fib target. And now we got the RTX sell. The only thing that's going on here that is going to keep this market very firm and maybe, like I said, in a sideways range, these RTX sell signals, what they suggest is that we get 1 to 2 bars of sideways with a slight bias to the downside. It doesn't necessarily mean it's the end and the top is in and all that. It just means that that's the case, especially when we look at the PPMs down here below, and they're just so robust. Plus 2.55, plus 1.29, and plus 2.26 PPM 1, 2, and 3. Anything over 0.25's a trend. This is 5-6 times. This is a crazy uptrend. And typically when we get those kind of numbers, they don't really get overbought. They can get overdone. But what will happen is it'll take several weeks, and the moving averages underneath here will start to catch up. We're at 308 on the 10-week moving average. That's going to be around 316 when we open tomorrow with the cash on a weekly. So that's going to jump about 8. And then the following week it'll be 322 and then 330 and so forth. And I've talked about some of these numbers here, but this is a very robust trend, and we're getting an acceleration on the trend as well. It's not like we're topping out here. Let's take a quick look at the daily. Daily got RTX sell signal. It closed at 3.43. Let me get the right numbers here. Just making sure this thing is moving right. Okay. Yeah, so the high was 3.71, and we closed at 3.70, and RXT was 3.58. That was on a daily. So we did get the down day on Friday. We should at least get another one. And as we look at the weekly that I just discussed, it's likely that we're going to get even more of those, sideways for up to the next couple weeks, which would be interesting with all the metrics we have coming out with PCI and GDP and all those numbers, deflators, you name it. There's quite a bit to digest as we go through this week. The other thing I'll mention here just real quick, I brought up the yield curve. Massive flattening in the yield curve. And I showed you, if you go back in the video, I think it was Wednesday, might have been Thursday's video, I went through expectations for the yield curve. And ultimately, the Fed funds, the very front end of the curve, will be at 4+. I think we could be as high as 4.5, and that won't be enough to do anything really for inflation as we know it. But that you'll have the front end there, and then all the back end stuff will be lower than the extreme front end. So the Fed funds, the up to 13-week T-bills, all of those would be ultimately higher than the 2, 5, and 10, and 30. We'll have this big downward slope on the back end of this thing. And what that ultimately could be signaling is some sort of maybe stagflation. That's what everybody fears right now, that we end up in a massive recession and we have inflation, and that would be a pretty ugly scenario, to say the least. But like I said, for right now, the labor stats keep going on. So let's go ahead and let's talk currencies for a little bit. I normally don't cover them a lot, but it seems to be pretty appropriate here. Yeah, so the dollar has pulled back just a little bit. We printed up the 114.53. The fib targets that I've been talking about here, we look at those. Let me get them up on the screen so you can see them in the pop-up. Let me get to the weekly because that's where the big targets are. There we go. So what we're looking at here is 112.63 was target 1, target 2, 115.68, 117.57. And once again, if we look at the PPMs, we're accelerating. So it looks very similar to how the 10-year and the interest rates look as well. So everything's still big time trend mode. Also seeing acceleration of the trend to the upside. So it's not that we're seeing any type of downward movements or any real potential on material downward movement. And, we saw maybe 2 weeks sideways, and then last week we exploded up. I just want to bring this up. We did get the RXT last week was a 111.93, and we closed at, let me get the close up here so we can see that. Yeah, this was last week. So 111.93. We closed at 112.98. So we got an RXT sell on the dollar. So it's going to get interesting. You can almost argue that we've satisfied fib target 2, 115.68. Like I said, the high so far just overnight has been 114.53. So we definitely have a big bid here. Like I said, everything's accelerating. There's no signs that this thing is really over. So I mentioned the yen a little bit ago. Let me bring up the yen because there was something that happened there. Of course, this is the monthly. Let me go full screen. This is the monthly. It's just vertical, but actually that's the 3-month, the quarterly. Let's go to the daily because I thought this was extremely interesting. You'll see this big red bar here. That was Thursday's action. And if you look back, the range of Thursday, this was the day the BOJ came in and intervened in JGBs, and they're trying to support the currency and their bonds and everything. This was a massive day, and we're trading back up into this. But if you look at where the dollar is, where I just showed you, printing up at almost 115, the yen you would think would be much lower. So whatever they did the other day, at least for the moment, has affected the market sentiment. And when I see a range like that, I counted back. The range was a higher high and a lower low than all of the bars for 11 sessions. And typically when you get that type of engulfing pattern like that, it's some significant top. So if we can't get through this top here that we printed the other day, let me just get the numbers up here. 146.50. We can't get above that number, then we're probably going to see some maybe more sideways, potentially some stability in the Japanese yen. But I just thought that was interesting. So if anybody's doing anything in yen or anything like that, it looks like maybe that was climactic. All the other currencies, bar none, are still getting hammered. And this is the only one I saw that wasn't printing new lows or the dollar wasn't making new highs against them. This was interesting. So keep an eye on this one. So something I didn't think could happen last week did happen. And what that was is I thought we'd hold the 80 handle in crude oil. And this is some of what's coming about with I'm talking about potential of some kind of deflationary pressures coming in. The crude printing 78.49 is big, and it just this is the weird thing. And I've been trying to put this together and try to explain what the hypothesis is here, but it's really a combination of things. Is the demand is dropping substantially, so the economy is probably slowing down in the world economy. Even though Hong Kong got open today, China is trying to get reopened with all their zero COVID policies. But all of this stuff, crude oil just continues to be under pressure. And I did not think we would be able to print under the 80 handle. We're 78.43. There were some numbers. I'm going to try to find those numbers that I was looking at. Let me get over here and I'll bring this back. Yeah, here it is. Let me bring this full screen. As the fib targets on a downside, 73.28, 66. 99, we'll call it 67, and then low target 63.11. So, I mean, those are pretty insane numbers. If we come back over here to the intermediate trends or the weekly charts, we look at the market grid for this week. S1 76.87. We haven't quite gotten to S1 weekly yet. S2 74.78, 72.70, and 70.83. So that's within the expectation range. On the upside, we're probably looking, now that we've broken down here, probably an 82.70. That was basically the number that I thought we would hold around 80 would be the extreme, and 82.92 if you recall, I was throwing that number around. But all those metrics all got flipped, and now we're probably more like a 76.82 now. And so it's amazing that we're seeing these metrics flop over here. And it's not because every car is electric. It's because of demand and maybe production coming in. There's talk of Iran, and let's face it, Russia hasn't stopped producing anything. They're still selling and producing. And they might be doing a discount, but it ultimately takes other buyers out of the market. So it's interesting. And it's sort of looking like, if you're in Europe, let me know if what I'm reading is true, but it looks like there's a deal with Abu Dhabi, and there's some other nat gas deals coming in all of a sudden. It's looking like you folks aren't going to freeze to death. Not that your governments won't try to ration it anyway. But the point is that it looks like there's going to be maybe not more than enough, but more than people thought there was going to be, and that whole scenario that played out. And so I mean, nat gas is still going to have a decent bid in it, and it's interesting because there's a couple bills in front of Congress right now that are trying to put together more facilities to actually ration supplies from the U.S. consumer over to Europe, and they're calling it some kind of a war emergency. I'm doing air quotes here. And yeah, so we'll see what all comes out of this, but it looks like there's a concerted effort to make sure that you folks over there are going to have some decent nat gas. So please comment in the comments if you're watching the replay or whatever. I'd like to see your comments on that. Real quick, just going over back to the daily, the market grid for today, 76.46 is S2, S1 77.66. So watch those two numbers on the downside to see if they hold. PPM's super negative, minus 1.06, 0.78. Everything's in a downtrend. It's hard to find anything that looks like it's in an uptrend at all anywhere other than the Dow. Dow seems to be the only thing that's advancing. All right, so next we'll do gold. Just got two more markets to go, and we'll be done for tonight. Thanks, everybody, for your patience. It's a long stream tonight, I know, but I appreciate everybody that's hanging out watching. The gold is down 0.5%. We're at 1647. Looking at the fib targets, there's 1636, 1617 is still out there. 1666 was low target 1 or fib target 1. So we're trying to trade down into these target ranges. So look for 1636, 1670. And I've been arguing for a while that we're probably should be at 1550. There just doesn't seem any reason. Let's see how that weekly chart's doing, because that's been a big deal. That very interesting. The PPM1 was turning up. It looked like we're trying to put a bottom in. That's turned back south. PPM2 is stable, but it's down big time, 0.69. PPM3 down 0.26. So just like I said a second ago, just about everything we look at, everything is being liquidated. All assets are declining. There's nothing going on at all from the standpoint of any reason to own anything. Is the way it feels right now, right? Like I said, other than the Dow. So I think this trend is going to continue. Like I had talked about the potential of gold making a turn if it could hold some numbers. Well, it didn't. It continued to decline here. Just putting those numbers up on a screen. The market grid numbers for this week are 1641. We've already printed 33, so that was S1. S2, 1626, 1611, 1597. So it could get ugly by the time the end of the week is out, especially if we see the Dow start to move up a bit more. Finally, we'll cover Bitcoin. Bitcoin is under pressure, about 1%. As I've said before, both gold and Bitcoin seem to be in similar configurations. This is the weekly. We were starting to get some upward potential on some of the PPMs, and they've just faded. Now we're full on back in downtrend mode. And I'll show you on the dailies. I've been mentioning this number, but it's starting to look more realistic here. The 18,555 has been a number. We're trading 18,841. We dip under that and we catch a little bit with 18,188. This chart will update, and about 2 hours, 4 hours, I guess, at the midnight in Eastern time. But once again, PPMs, they're not accelerating, but they're just so negative that they don't have to. There's just big time downtrends across the board. Let me show you this angle of attack on the daily. So the daily is still down 0.76, even though PPM 1 is turned up. It's not crossing first, second derivatives. PPM 2 has crossed. PPM 3 is trying, but the projections are still for a minimum move down to 16,112. And I think we get a daily close, especially if we were to finish tonight under that 18,555 number. That's probably going to be the trigger point for it to decline from here. And like I said, there just doesn't seem to be anything there to really point to that would be bullish. Everything, all the PPMs, weekly, daily, on every market we looked at tonight, by the way. But two things that are exception. The 10-year, so the interest rates, they're all angle of attack is up. All of those angles are up. So the dollar and interest rates, yields are going up, dollars going up. Those are the only two markets that have positive PPMs that we looked at tonight. Everything is negative. And it doesn't appear that all of these markets are at some extreme yet to get some bounce, even though when you get into these kind of markets, anything can happen at any moment in time, especially with some of the volatility numbers that we've seen. So, just be, as always, I tell you, be cautious. It's been fun, for the decline, but there's always these rip your face off rallies that can happen from anywhere. But everything is in a downtrend, and there's no doubt about that. So that's going to do the video for tonight. Yeah, you're probably right. I just saw a comment by Chris, and you're probably right about that. But on the Bitcoin price, yeah, it's just like gold, all of these, a bunch of this stuff. There's no assets are going to look good. And I think there's something interesting, folks, that you all need to, I know a lot of folks that have been in the markets, never seen a bear market before. And now that we have fully liquidated everything, we're into an extreme situation here. And this could last, like I said, if you go back and look at the index setup that I'm talking about, this could last for at least 2 or 3 more quarters, could carry us well into 23, at least Q1, possibility of Q2. So we're just going to be in some pretty rough markets here. And I mentioned on Thursday night's rally broadcast for Friday is that I'm just not looking forward to maybe getting into another 2000 to 2003. I think it was October of 2002 when the markets finally started to bottom. It wasn't until spring, February, March of 03 where we started to see a bit of a turn. So this is going to be a long one. There's a lot to work out, and there's a lot of risk in here. And I'll just kind of unpack this stuff as we go through the week. Like I said on Thursday night's video, just trying to close down here, is that you need to watch all the bond actions and make sure we don't have any kind of disasters there, because if we have a disaster in any of the bond auctions, I don't care what the duration is. And the way to figure out disaster is that your coverage is well under 2 to 1, and you have a tail. It's called a tail on the trades of maybe anything over 5, maybe 6 basis points. If it's beyond that, people are going to freak out on this stuff, and especially if no one's showing up to buy treasuries on a large scale, and it doesn't look like they are, that's going to create a lot of havoc in the financial markets. And this may be more of a bond/debt crisis that finally is occurring than anything to do with equities or even the economic conditions. It's going to be these financial conditions that could roll the market pretty good. Anyway, folks, I will see you the same time tomorrow night. Those of you in the live room, be there at 1 o'clock Eastern time. Looking forward to spending some time with you all. All right. Have a great evening, folks.